Hello, my name is Alex Merced, one of the instructors here at Greco Financial Training. And if you're watching this video, basically what we're going to be doing in this video is going over many of the introductory terms you need to know regarding the financial industry and financial products. One, to help you, one, understand the industry better, and two, to get you started on the right foot when taking one of our Greco on-demand online courses. So whether you're taking Series 27, Series 24, Series 7, the Securities Industry Essentials Exam, the 63, the 66, whatever exam, this video will be very, very helpful. Now, if you have friends who are interested in joining the industry, advise them to take their Securities Industry Essentials Exam, which is now sort of the doorway to everything else. But enjoy the following video and learn all these terms, because all these terms are used on all these exams that you need to get your license to move your career forward. My name is Alex Merced from Greco Financial Training, and enjoy.
Introductory finance topics. Learn more from our courses at greco.com. The primary market, where companies, known as issuers, create securities, such as stocks and bonds, to raise money. So basically, if a company wants to raise $100 million, they could issue stock in the primary market, or they can issue bonds in the primary market to raise that money. An initial public offering. When a company issues stock to the public for the very first time, they issue it at a price called the POP, or the public offering price. The process of issuing the stock for the first time is called an initial public offering, or an IPO. A primary offering. A primary offering is any offering of securities where the money from the sale goes to the issuer. So the money goes to the actual company. So if Facebook issues Facebook stock and the money goes to the corporation's bank account, that's a primary offering. A secondary offering. A secondary offering is any offering of securities where the money from the sale goes to a non-issuer, so not the company. So if Facebook issues Facebook shares, any money that would go to Mark Zuckerberg, the CEO of the company, that would be considered a secondary offering because Mark Zuckerberg is not Facebook. Special broker-dealers, known as investment banks, will sell the new securities to the public. This process is called underwriting. When investment banks are underwriting a new issue to reduce the risk and share the responsibility of selling, they'll form groups called syndicates and split the profits with the other investment banks in the syndicate. The secondary market, when securities trade between investors on exchanges like the New York Stock Exchange or NASAA, or over the counter between dealers off the exchange. The Securities Exchange Commission. This is the government agency that was created by the Securities Exchange Act of 1934 to oversee exchanges, issuers, broker-dealers, and investment advisors. The Financial Industry Regulatory Authority, FINRA. The Financial Industry Regulatory Authority, or FINRA, is the self-regulatory organization, SRO, overseeing and regulating broker-dealer operations. An SRO is a non-governmental agency that does regulation. So FINRA does regulation of broker-dealers who have to become a member of FINRA. The Chicago Board of Options Exchange, or the CBOE. The CBOE is an exchange for the trading of options contracts, as well as being the SRO that sets many of the rules for trading options. So whenever you think of options contracts, a derivative product, the regulator is the CBOE. The Municipal Securities Rulemaking Board, or the MSRB. This is the SRO that creates rules and regulations for municipal bond trading and underwriting. The MSRB does not enforce its rules. The MSRB rules are enforced by other regulators such as FINRA and the Federal Reserve. The Treasury Department and the Internal Revenue Service, or the IRS. The IRS is a department in the Treasury that oversees the collection of taxes. They are the main authority regarding many of the rules around retirement accounts. So whenever you think of anything to do with taxes, like retirement accounts, which are tax deferred, or all the rules on buying and selling stock and what taxes are applicable, that's all managed by the IRS. The North American Securities Administrators Association, also known as NASAA, an organization made up of the securities administrators of each state who enforce state securities regulations. Not only are there federal regulations, which are enforced by the SEC, but every state has their own rules regarding securities, which has a framework that was established called the Uniform Securities Act. These are enforced by each state's securities administrator. The Federal Reserve, the central bank of the United States, which beyond conducting monetary policy, also acts as a regulator of the banking system. The Securities Investor Protection Corporation, or SIPC, a government-created insurance agency which insures the customers of a broker-dealer in case the broker-dealer mishandled customer funds. Usually if a broker-dealer goes out of business, if it's followed all the rules, the customer's money and security should be safely sound. But just in case that is not the case, SIPC will insure the customer's funds. The Federal Deposit Insurance Corporation, or the FDIC, a government-created insurance agency that insures banks' depositors in case of a bank's insolvency. So if a bank goes out of business, you don't have to worry about losing your money in your savings or checking account because you're insured up to certain amounts with the FDIC. A retail investor. This is an individual investor investing their own money into securities. So when individuals buy stocks, buy bonds, buy mutual funds, they are acting as a retail investor. An institutional investor includes portfolio managers investing on behalf of pension funds, mutual funds, insurance companies, hedge funds, and other financial institutions. So it's not just one person's money, there are large groups of money that represent lots of individual investments. Accredited investors. This is an investor with at least $1 million of liquid net worth or $200,000 of annual income if they're filing single, or $300,000 of annual income if they're filing joint. A broker-dealer, or a BD. This is a financial institution in the business of being paid for affecting securities transactions for the account of others, meaning they're acting as a broker or agent, or for their own account, which means they're acting as a dealer or principal. A carrying firm. This is a broker-dealer which carries customers' accounts, meaning it takes custody of customer cash and securities. An introducing broker-dealer, or a fully disclosed broker-dealer. This is a broker-dealer which hires a separate clearing firm to carry its customers' accounts. This broker-dealer does not take custody of its customers' cash and securities. Prime brokerage. A prime broker is a broker-dealer that will provide custody and financing services for other financial institutions such as hedge funds, other broker-dealers, pension funds, who then hire a separate executions broker-dealer to execute the trades. An investment advisor. This is a financial institution in the business of being paid to provide advice on securities investment. So unlike a broker-dealer which is paid for the transaction, an investment advisor is paid for the advice that they're given. A municipal advisor. This is a broker-dealer that works with municipalities, which are states, towns, counties, in advising them about offering structures for new municipal bond offerings and soliciting them about new municipal bond offering advice. Issuers. These are companies or governments who create securities to raise money. So when a company issues stocks or bonds, or when a government, like the US government, issues Treasury bonds, they are issuers of those securities. A trader is anyone engaged in the buying or selling securities in the secondary market for profit. So they're just looking to buy at one price, sell at a higher price. A market maker is a dealer in the security. Specifically, it's a broker-dealer who commits to making a two-sided market, meaning they're always buying and always selling in a particular stock or security, by doing so, they are providing liquidity to the market. Custodians, financial institutions that are paid to take custody of customer funds, so they are actually holding on to the money or securities of customers. Transfer agents and registrars. These are institutions hired to either handle the creation and destruction of shares, meaning transferring, or keep records of who owns the shares, registration. Deposit Trust Clearing Corporation and the National Securities Clearing Corporation. DTCC, the Deposit Trust and Clearing Corporation, and the National Securities Clearing Corporation, NSCC, provide custody and clearing services for broker-dealers. These are some of the biggest entities that really, truly hold all customer securities when broker-dealers do transactions between each other.